Hello, Professor and classmates. Here is Group Three's presentation on the case study of Fullerton, Risk Analytics and Business Strategy. Group members are Charles Soche, Carly Sturm, Carmen Schern, and Stephanie Kane. This is for the fall semester of 2020. Fullerton India Credit Company Limited is registered as NBFC, Investment and Credit Company, with the Reserve Bank of India. The classification as a non-banking financial company, or NBFC, under the Indian Companies Act of 1954 is internally regulated by the Reserve Bank of India in compliance with the Basel Accord internationally. NBFCs are less regulated and can be 100% foreign-owned in India. Fullerton India is a subsidiary of Fullerton Financial Holdings Private Limited, which in turn is a subsidiary of Temasek Holdings Private Limited, which is headquartered in Singapore. NBFCs need to maintain a capital adequacy ratio of 15% compared to regular banks needing a capital adequacy ratio of 8%. India is considered an emerging market with tremendous growth potential. According to data gathered by the World Bank for 2019, India's nominal per capita income was approximately $2,104. Over the course of the last 20 years, India's growth rate has been at or above 4%, which is significantly higher than growth rate of many developed nations. Despite the Q3 2019 economic dip in growth, India still has many factors that are appealing to investors internationally. Since all markets are interconnected through globalization, if one market fails, it does not solely impact one location. In order to prevent a negative domino effect to those markets directly and indirectly affected, analyzing internal practices and applying external regulations such as the Basel Accord can reduce risk. The Basel Accord ensures that banks hold sufficient capital to absorb losses with a reasonably high degree of probability and circumvents big losses with low probability. NBFCs are required to maintain a capital adequacy ratio of 15% based on this regulation. This CAR percentage is divided by two tiers. Tier 1 is main capital 10.9%, and Tier 2 supplemental is 2%. It may present a difficult challenge for emerging markets to hold this amount of total risk-based assets. The total risk-based assets factored in the CAR calculation ensures that if local regulations or intercompany guidelines have weak assurance standards, the company assets are sufficient to protect it from financial risk. Prior to 2007, Fullerton provided consumers and small enterprises in urban and rural India with relatively small loans. The average loan size was about $750 for a customer and up to $1,500 for a commercial loan. Most of the recipients of the loans did not have credit information reported, which made credit risk analysis a challenge. Consumers who were underserved by traditional banking institutions were not allowed to make deposits on loans, leaving many lower-income consumers to default. Fullerton's weak credit issuance standards had also exposed the company to significant risk and led its parent company, Temasek, to inject new capital into the company to keep it afloat after the financial crisis of 2008. Although there were many challenges based on risk factors, the level of risk appetite matched or exceeded the possible exposure at the current level. Strategic business planning was required to reach long-term goals for the company and get through the global financial crisis. In 2010, the new CEO, Shantanu Mitra, with over 30 years of credit and risk management experience, led the company through necessary shifts in its lending operations. Fullerton decreased locations from 850 to 340, with the reduction of location staff members from 16,000 employees to only 5,700 employees. Fullerton then sought out consumers with higher incomes from 6,000 to 15,000 annual income, focusing on two key groups: aspirers that are between half a million and 1.1 million Indian rupees, and the affluent, which had an annual household income of more than 1.1 million Indian rupees. Fullerton also increased average loan size from $1,042 to $3,529. The company increased rural loan products such as personal, group, and vehicle mortgages. Fullerton targeted the typically underserved sections of the market, which provided the chance for generally high profit margins within normal business operations, but opened them up to a higher risk of loss during any potential economic downturns. Mitra, the newly appointed CEO, saw an opportunity to instill new lending practices with data analytics at the core of the new approach. This new lending approach would utilize data analytics to better target customers and offer more precise products and pricing levels to maintain a strong profit margin while still balancing risk more appropriately. This was a similar approach to lending that is typically utilized by larger foreign banks within more traditional market segments, but was a novel approach for a company like Fullerton. In 2012, Mitra set up a new risk analytics team to help implement his new approach. This team was put in charge of integrating risk analytics into market assessments, customer acquisition, and credit portfolio management, among other items. Motivation to develop a better risk analytics approach was vital to make certain Fullerton had an acceptable balance between the risk appetite of the firm and the risk exposure that occurred by its lending decisions. It is necessary to properly assess risk exposure across the entire firm by balancing the risk and return trade-offs not only in a well-performing economy, but in a recession as well. It was important for Fullerton to assure a proper level of capital was set aside for these potential recessionary periods as a business practice, as well as in order to maintain compliance with necessary regulatory requirements. Exhibit 7 in the case demonstrates the risk appetite framework within Fullerton. A risk appetite statement, or RAS, is a document which assesses and states a company's overall tone regarding risk management. Essentially, this is put together to help an organization determine the level of risk they are prepared to take on with normal business activity. The document is approved by the Board of Directors and used to define metrics for Fullerton as a whole. These metrics work together to measure and monitor both capital implications as well as risk-return implications. These two outcomes are measured and monitored using the metrics listed here and are used to make business decisions during changing or challenging economic times. Exhibit 8 further details the loss parameters determined by Fullerton and based on industry practices and Basel II norms. These loss metrics capture an overview of the risk Fullerton faces during standard economic times. PD, or probability of default, is defined as the likelihood that an account becomes over 90 days past due within the next 12 months. EAD is defined as the exposure at the time of default, which is representative of the balance outstanding at the time of default. Finally, LGD, or loss given default, is a percentage of the balance Fullerton expects to lose after potential recoveries and/or collection costs. By multiplying these three factors together, you calculate the expected loss, which is then aggregated for the entire portfolio to get a better estimation. One key decision by Fullerton was to make changes in their current credit underwriting process to integrate the use of data and help maintain a more even risk management approach. The first change was to move from a branch-based decentralized credit underwriting process to a centralized model with reliance on both internal and credit bureau data. It was also vital to separate the duties of loan origination and credit approval into different teams to ensure better adherence to risk tolerance levels. They also separated risk staff from sales staff to ensure independent risk management decisions were being made without influence of revenue goals and targets. A new automated application scorecard was developed to rate the risk of new customers using a logistic regression model based on a customer's information from the application and the credit bureau reports. Applications were then broken into three buckets. Green was auto-approve, yellow was manual review, red was auto-reject. This automation significantly reduced the amount of time taken to review an application and provided a level of predictability for the loan officers by removing potential judgment biases. This process implementation actually increased the loan approval rate over time and led to a more balanced credit portfolio for Fullerton. Fullerton's analytics became crucial for the company. They embedded analytics in customer retention and acquisitions, collections, recovery, credit assessment, credit information report, scrubbing, and cross-selling. This was only a short list provided of all the places Fullerton began to implement analytics. Telecollectors and third-party collectors, along with field collectors, segmented their work zones by product type, which allowed for more efficiency and effectiveness. Branch's fraud detection was strengthened through neural network algorithms and self-assessment checklists. Adding more security is important for Fullerton because they have focused on unsecured loans. By writing off bad loans early, Fullerton is able to match risk alignment with risk appetite. This is important for the analytics of asset classification and provisioning. Fullerton's strict bad loan policy flows into their asset classification, and their policy is much stricter than the Reserve Bank of India specifications for NBFCs. Shantanu Mitra is focused on building an analytics-driven organization, and the data received from writing off bad loans earlier than the norm allows for better understanding of the risk versus reward. In only 3 short years, Mitra had established a competent team who had developed a strong data analytics framework. He believed that no other non-banking financial company in the India sector could compare to their ability to leverage data. He looked to the future and identified specific areas for the analytics team to focus on. This includes balancing the loan portfolio, product and geographical mix in the unsecured retail segment, and designing and managing the implementation of that framework. The Fullerton portfolio leaned heavily towards unsecured loans at 80% and only 20% secured. Mitra implemented a process to skew the favor towards secured loans. The next slide shows 4 possible scenarios. The issue that arose was the board was uncomfortable with the stress period credit risk above 1.0. Again, Fullerton has always focused on unsecured loans. Secured loans have a lower delinquency rate, but they also have a lower profit margin. Fullerton's risk analytics need to find the appropriate balance for their risk appetite. Mitra challenged his team to analyze and quantify the effect of this change. They used risk models to estimate losses, and obviously scenarios 3 and 4 would not be attractive to the team members or the board. The question is, how far does Mitra want to go with this skew? Could he convince the board members to allow for more risk to possibly have more reward? Or will he be contained to scenario 2? Obviously, unsecured loan customers make up the majority of their business, and they must determine if they would make as much money with the secured loans as they do with the unsecured loans. Scenario 1 presents the highest economic capital, and that may be attractive enough to the board to raise the risk appetite to 1.2%. Here you can see the differences between the 4 scenarios. With the higher percentage of unsecured loans, as seen in scenario 1, the risk is greatest. Therefore, the reward is the greatest when everything works to Fullerton's favor. The potential loss columns in green are highest within the highest rated unsecured loan scenarios. In these scenarios, Fullerton would be writing off a larger amount of their net receivables, but also incurring more expenses because a higher amount of resources would need to be allocated to debt collection. The data that comes from unsecured retail loans will give the analytics team the best information to sustain a competitive advantage. Data collected from secure loans and unsecured rural loans provides less insight because most of the loans were based on relationships. The unsecured retail segment consists of 2 types of loans: salaried customers and self-employed customers who own and operate their own small businesses. Loans were dispersed to metro areas and Tier 1 through 4 areas. Tier 1 through 4 areas are smaller towns and cities, and the loan size depends on the tier. 1 is high and 4 is low. The loans for self-employed customers were generally double the size of salaried customers. The outstanding loan balance increased from one year to the next, meaning that Fullerton appears to be gaining more customers. This is a good sign for the company, especially with the 30 and 90-day past due rates trending downward. The data analytics team will be able to use this data moving forward and extrapolate where they may be able to improve or advance. As you can see, the net loss within the self-employed unsecured loans was more than one-third of the outstanding receivables before 2011. Some of this may have been people still defaulting on loans from the economic recession in 2008. But when the data analytics were implemented, these numbers severely dropped for all segments because Fullerton was better able to discern their customers with the balanced scorecard approach and give customers the appropriate rates that match their credit histories and Fullerton's risk appetite. Projected growth trends are not consistent with Fullerton's objectives and the board's requirement of a 1.0% RLM. Metro and Tier 1 personal loan salaried customers are exactly where the company needs to be. So the focus should be on Tier 2 through 4 to raise RLM and lower RAR. The 2.8% RLM of Metro personal loan self-employed customers is troubling and should be immediately attended to. On average, personal loans for self-employed customers should be double salaried customers, and that is not what is displayed in this analysis. This is just the visualization of the last slide, as well as the map of their distribution network to show their geographic expansion and what markets they serve in various states and union territories. The issue that Fullerton is facing involves the disagreement of objectives between the field agents and regional heads. Field agents are incentivized by volume. The more deals they close, the more money they will make. They are unconcerned with net margins, while regional heads encouraged average interest rates and, of course, net margins. The dichotomy of incentive program at Fullerton needs to be analyzed and reworked so the employees in the field and the employees in the home office are working towards the same goal. Mitra set his analytics team to work to design an incentive program that would help field agents employ correct behavior. Mitra assigned Ganguly and his team the task of coming up with a business plan that encompassed everything they had discovered using data analysis. The team must define the desired shape, product mix, and geographical mix of the portfolio for the unsecured urban retail segment. They used a top-down decision-making process to gather the necessary data. After defining the portfolio, they identified the profitable market segments by product categories and geographical locations. The main mission is to maximize profits while keeping risk exposure at an acceptable level, especially during times of stress or recessionary periods. Lastly is the issue of incentives for field agents. The team must come up with an incentive program that will align the objectives of the field agents with those of the regional heads. They are hopeful that data analytics will give them a competitive advantage in the highly competitive Indian lending business. With Fullerton's use of data and risk analytics, they have been able to grow at a substantial rate. Their urban and rural division are now separated, with over 3 million current customers. Expansion has occurred again at a more reduced rate when they first started. They are more focused on sustainable growth. They have over 640 branches in almost every state and union territory. They have focused on digitization as well. Fullerton has partnered with more than 30 financial tech companies, improved efficiency through end-to-end system integrations, implemented real-time dashboards for their customers, and started using robotic process automation for straight-through bookings. All this data in the two following slides is from Fullerton's annual reports 2019 and 2020. Our group is all accountants, so of course we like to focus on the financial aspects. Fullerton is investing heavily into building cutting-edge engineering capabilities. The movement to Agile DevOps, hiring of developers, architects, Scrum Masters, and a 30% growth in investment are a reflection of Fullerton's commitment to building a truly digital lending company. Analytics continues to be Fullerton's strength, with its commitment to leveraging advanced machine learning capabilities across different stages of the customer life cycle to help drive rapid business growth while maintaining a healthy credit profile. Fullerton management's focus on data and algorithmic model-based decision-making has been a key enabler in ensuring sharp growth in business profitability. Moving ahead, investment in data engineering capabilities combined with advanced data science capabilities is expected to be a key source of their competitive advantage. Over the years, Fullerton has progressively invested in building a solid foundation of data and analytics that has now matured and proven its success in producing the intended outcomes. Analytics, coupled with machine learning and artificial intelligence, has become a mainstream force. This helps Fullerton in improving credit decisions and customer experiences while reducing risks and costs that are instrumental in their business success. Advancements and the ability to leverage IT to drive business outcomes is the cornerstone of enhancing the quality of their business operations, while reducing the time to market their solutions and provide deeper value to their customers. Investment in technology in 2019 and 2020 grew by 35%, while the workforce expanded by 25%. Additionally, Fullerton sharpened their focus and strengthened their commitment by taking forward their well-established strategy of Agile IT. Hopefully you are still with us and that wasn't an overload of information about Indian lending processes and risk analytics. Here are some of the discussion questions we would like to focus on. What change would have the most positive impact for Fullerton? Volume of sales, their sales force structure, or incentivizing the sales force, and why? What would be the dangers of using analytics for Fullerton? Which aspect is most important for the desired strategic transition in the Fullerton portfolio? The portfolio shape, the product mix, or the geographical mix, and why? And last, how does globalization and investments for more established markets impact growth in emerging markets such as India? Please feel free to answer any or all these questions on the discussion page in D2L throughout the week. Thanks for listening.